Hey everyone, Steve here. So in this video, I wanted to review or respond to a few online videos I've seen recently regarding how to pay your mortgage off in 5 to 7 years using what they call velocity banking. Now, a little bit of background, I am a finance major. I have worked in corporate America for the last 20 years and use numbers almost every single day at work. And I've watched a number of these velocity banking videos, and two things kind of popped up. First off, I had to watch a couple of different ones because the first few I watched were just unclear, really weren't explained very well. And then when I finally found one, and I'll put the link in the description below, but when I finally found one that really detailed and explained what velocity banking is and conceptually why you would move your money around, I had to watch it 3 or 4 times. And the reason being is that I was still waiting for that big aha moment. I was waiting for something to hit me right in the face and say, okay, Steve, you've been missing it. Here's what it is. Unfortunately, that never came. So the challenge I would have here today, the velocity guys, feel free to add some comments below and tell me what I'm missing, because I must be missing something. You guys are really pushing the velocity banking, so I must be missing something that's very simple that I'm perhaps overlooking. So love to understand what that is. With that being said, I did want to post this video because I see a lot of people commenting at the bottom of these velocity banking videos, and they are saying things like, hey, this is great information. I wish I would have known this when I bought my house 10 years ago. Or this is good information. I'm getting ready to buy a house and I'm going to apply this method to my mortgage. My concern with that is that I don't know if those people understand the risks that are involved with velocity banking, and I don't know if they truly have looked through the numbers and tried to gain an understanding of what it really is. So with that being said, I do want to kind of break down what velocity banking is. You can see on my screen, this diagram here, you're going to see on a number of velocity banking videos, if you will. It's the same numbers used over and over and over again. It's kind of red flag number one. It seems like somebody came up with this idea and all of these other videos are simply using the same numbers and not modifying it. So that's a little bit interesting that they're all using the same numbers and not using something different out there. It's almost like they're just piggybacking off of it and saying, hey, I'm going to use the same numbers. I'm just regurgitating the information. Don't know if that's true or not, but that's what it seems like anyhow. So the concept behind velocity banking, at least to set the stage here, is that you're taking $5,000 into your house. So every month, and this is on a monthly basis, you're pulling in $5,000 income. Now out of that $5,000, you're going to put some in checking and you're going to put some in savings. Now the checking is going to be used to pay off your mortgage. In the example they use is $1,200. You're going to pay off your car, or put a payment towards your car, and that's a $600 payment. Now that's a big payment. I don't know if that's including, and they don't really break it down. I don't know if that is including mortgage, probably not mortgage, but insurance, as well as gas and maintenance and repairs. I don't know if that's in there or not, or if that's just a straight car payment. They don't really break it down. You're going to put in $600 towards your credit card, and that's understandable. And then that's going to leave you with an additional $1,200 left over for your lifestyle. And again, they don't really break down what lifestyle is, but that total turns out to be $3,600. So it's $3,600 into your checking, and then $3,600 pretty much right out of your checking to pay your bills. The remainder amount, which is the $1,400 you're seeing, goes into your savings. Red flag number one, I honestly find it hard to believe that if you're pulling in $5,000 a month that you are actually saving $1,400 a month. I know very few people that actually save $1,400 a month. I'm not saying that if you're watching this, you're not doing this. I'm simply saying on average, most people are probably not stocking away $1,400 a month. The other red flags I would have here are when you think about your lifestyle changes or your lifestyle, I think there's a couple of things you have to think about. I've only outlined a few. Home insurance, property taxes, which are not included in this mortgage, is $1,200. Food, water, and I want to come back to food. Electric, gas, cell, internet, cable, lawn service. You're going to have lawn service if you buy a house. Life insurance if you have any. Personal care such as shampoo, shaving products, just hygiene type products you're going to need. Not to mention the items that I covered down here, such as clothing, tobacco, alcohol, sports, pets, children, right? Pets, if you have pets, you're going to have to feed those pets. You have to take them to the vet. You're going to buy toys for your pets, possible dog walkers, dog sitters, HOA, homeowners association fees, home repairs, and the list goes on, right? There's a lot of money that goes out when you own a house that are beyond the $1,200 mortgage. Now, One could argue and say that some of these are going to be wrapped up in the $600 credit card, and that's fine. They definitely can be. But you can see just with the items that I've listed here, and I'm being fairly conservative here. Home insurance of $100 a month is only $1,200 a year. Property taxes of $100 is only $1,200 a year. Very conservative. Food, $450 a month is extremely conservative. When you think about it, you have 30 days in the month. You eat 3 meals a day. Now, let's just say that the 3 meals per day are going to be cost per meal is $5. Then each day, or I shouldn't say each day, but each month, it's going to be M8 times N8 times 08. You're basically spending $450 a month just on food for one person if every single meal you're eating is only $5. It doesn't include snacking, that doesn't include going out to a restaurant. And quite honestly, it's very difficult to eat on $5 a day unless you're eating at McDonald's every day. And quite honestly, if you're eating at McDonald's every single day, you're probably going to be dead in 3 years anyhow, so you don't need to worry about paying off your mortgage in 5 to 7 years. The other thing to kind of think about here is that your salary here, if you're taking in $5,000 a month, that's post-tax, right? Because you don't pay your mortgage and car and credit cards pre-tax, right? They're going to tax your income. So you're probably going to have to make, so that's $60,000 coming into your house. You're probably going to have to make somewhere around $75,000 to $85,000, depending on the number of dependents you're claiming and how you have your taxes set up. So just some things to think about. You can definitely see that just with these, a few things that I called out here, you're well over that $1,200 in your lifestyle. And again, one could argue that the credit card is picking up some of these remaining ones. But just keep in mind that this is very conservative. Again, food at $450 is 3 meals a day, 5 days a meal for one person. If you have a spouse, if you have kids, that number is going to be well over $1,000 a month just in food alone for most people. So that's the model you're going to see. And the other thing to take in consideration on this model for Velocity Banking is that they say you have to pay down this credit card. You have to get rid of this credit card because you need this $600 that you're seeing here. You need that $600 in conjunction with the 14 over here. And we'll see why in just a minute. But you'll see this model over and over and over. But I do want you, if you are a new homeowner, to think about some of those other expenses you're going to have that you may not have today, especially if you're living at home with your parents. Probably not paying food, you're probably not paying water, you're not paying utilities, you're probably not paying the cable, you're probably not paying the lawn service, you're probably not paying all that stuff that you're going to have to pay when you buy a house, homeowners fees and things like that. Okay, so that's the general model you'll see on Velocity Banking. Let me jump over to an Excel amortization schedule, and I'm actually going to use the same numbers that the Velocity guys use in this amortization schedule, so you'll see the difference, you'll see where they're going with this, you'll have a good understanding of what they are doing and what they're proposing. So this is basically what your mortgage looks like on paper. Upper left-hand side over here, you basically have your loan information. And in this case here, we're going to borrow $200,000 at a 6% interest rate. I'm going to highlight that because I want to come back to that 6%. It's over a 30-year loan, and most loans, traditional loans, are going to be a 30-year fixed mortgage loans. There are other types of loans, but most of them are going to be a 30-year fixed rate mortgage loan. 12 payments per year. And that gives you a total of 360 payments. So if you look at the payment schedule over here, this is month 1, month 2, month 3, all the way down to 360 months or 30 years at 12. So these numbers over on the left, you'll see that your loan summary is over on the right. A couple things to point out over here. Scheduled payment is $1,199, so just about $1,200 per month. And that goes back to what we saw over in their example, $1,200 for your mortgage up here, okay? 360 payments, no surprise there, we'd have talked about that. And then the total interest, and I want you to kind of look at this total interest for just a second because the Velocity guys will key in on this total interest here. It's a lot of money, right? You're taking out a $200,000 loan, but you are paying $231,000 in interest, and that's only interest. So it is a lot of money, don't get me wrong. Now, what's interesting about the video I have, the link to the video I have down below is that video was posted in 2017. I don't know too many people that were getting a 6% interest rate in 2017. As a matter of fact, they were almost historic lows in 2017. People were getting in the 3 to 4% interest rate with good credit, 4 to 5 with okay to bad credit, quite honestly. And the difference is if you move this down to 5% interest rate, I want you to watch this 231 over here, but when we move it down to 5% interest rate, it went from 231 down to 186. And again, when you watch the velocity banking, they'll all use kind of these same numbers that you're seeing here. I don't know if they're using 6% because it makes the numbers look real ugly, and it does. You are paying a lot of interest, or if it's what the average person is paying on their mortgage. Couldn't tell you. But if you drop it down to 4%, where a lot of people were getting interest back, or probably a lot of people were getting an interest rate for a mortgage, 30-year fixed mortgage back in 2017, you'll see that your interest drops down to $143,000. So again, I don't know if they're playing with numbers there or not. Could be wrong. So let's move that back to 6%. We'll leave it there. $231,000 is your total interest. And let's talk about what you're seeing on row 11 down here. Very simple. This is your payment number 1. We talked about that before. This is your beginning balance. That's your $200,000 you're borrowing. Your scheduled payment is $1,199. We talked about that. Here's your $1,199. Extra payment we're going to come back to. We're going to come back to in just a minute, and we're going to talk about it in 2 different scenarios. So your total payment is $1,199, and this is interesting. Your principal is only paid down by $199, and you're paying $1,000 in interest. And that's where that $231,000 is coming from. At the front end of a loan, you are paying the majority of your payment, I should say, is going into your interest. Now that does go down over time and your principal goes up. So if you look at month number 2, you can see this jumps up to 200, 201, 202, 203 and onward. Your principal increases because you're paying down that principal balance that you are being charged interest on. And your interest actually correspondingly goes down, obviously. So your ending balance at the end of month 1 is $199,800. So even though you paid $1,200, you really only made a $200 dent for the most part in your principal balance, which means going into month number 2, you still have a $199,800 balance, which you're being charged 6% interest on. You're going to pay your $1,199. It's going to pay $200 towards the principal. Okay, so that's the way the amortization schedule works. Fairly simple, not very difficult. So the velocity banking guys are going to tell you that you want to chunk the information. You want to chunk your extra payments in here. So they're going to use an example of dropping in $13,000 into what we call an extra payment. Now I want you to notice a couple things when I drop this $13,000 in. I want you to keep an eye on the ending balance over here, and I want you to keep an eye on the total interest. Okay, ending balance is now down to $186,000, not $199,000. It's now down to $186,000. That means coming into month number 2, you owe interest on $186,000, not $199,000. It's a big difference. It's a big chunk of change. You'll also notice that your total interest dropped from $231,000 down to $177,000 for a difference of $54,000. Looks great on paper, right? I mean, it looks phenomenal. This is exactly what I want to do. And then they go on to say in month number 7, I believe it is, well, before we get there, we'll come back to that. So where do you get the $13,000 from? Most of us don't have $13,000 laying around that they can just drop into their mortgage. You get that from a credit card. And over here to the right, we have the credit card. Now you notice with the credit card, red flag number 2 or 3 or 4 or 5 for me, is that the interest rate is 20%. So now I'm taking $13,000 out of a loan. It's a big loan, but it's $13,000 out of a loan that I'm paying 6% interest on, and I'm moving it over to a credit card that I'm going to be paying 20% interest on. Red flag number 2, 3, 4, 5, I don't know what it is, but you traditionally never take one form of debt that has a low interest rate and move it into another form of debt that has a high interest rate. It just doesn't work. The math doesn't add up. Remember the $2,000 payment we talked about before over on the model over here? The $600 credit card and the $1,400 here being $2,000? That money, as opposed to putting into savings, as opposed to paying off the credit card, you have to get the credit card paid off first, is this payment right here. So you move $13,000 over. I should say you borrowed $13,000 from a high interest rate credit card and moved it over to your low interest rate mortgage. So now you have a beginning balance on your credit card of $13,000, which means you are still in debt, $100,000 or almost $200,000, right? If you look at it, you have $186,000 over here, but you have $13,000 over here. You're still in debt, $199,000. You really haven't done much to your mortgage at all. And we'll talk about what that looks like in just a minute. Your payment of $2,000 actually comes from what we talked about before, your savings. You're not putting anything into savings anymore, and that's fine. Savings you really don't earn hardly any interest on. So before you beat me up on savings not earning interest, you're exactly right. You don't earn anything on savings today. But you're not putting anything in savings at $1,400 in savings, which again, I'm hard to believe that most people are saving $1,400. You have paid off your credit card, and that's where you're getting your $2,000 from. If you look at the chart though, let's just go over here. If you look at the chart, you're still in debt. You have $186,000 and really $800 at 6% interest, and then you have $13,000 at 20% interest. So no matter how you cut it, you're still in debt about $199,000. It's just that one you're paying 6% interest, and then one you're paying 20% interest on. And the Velocity guys will talk to you about this Celsius versus Fahrenheit here, which is, in my opinion, a total sham. If you look at Celsius at 0 degrees, it's the same as Fahrenheit at 32 degrees. So a very small number is the same as a larger number from a temperature perspective. However, if you move Celsius up by 1 degree and you leave Fahrenheit at 32 degrees, 1 degree is hotter, right? I don't think anybody's going to argue that. 1 degree is definitely hotter than 32 degrees. 1 degree Celsius, I should say, is definitely hotter than 32 degrees Fahrenheit. I don't think anybody's going to argue that. The point they're trying to make is that this number is actually hotter, it's bigger. So they're kind of relating that over here, saying, well, even though you have $13,000 over here, you're paying 6% interest on this giant number. But it doesn't matter. You're paying 6% interest on this giant number, yes. But in this example, you're paying 20% interest on that number you simply moved over. You're just shifting money around is all you're doing here. It doesn't really matter how you look at it. You are still in debt about $200,000. One you're paying 6% interest, and one you're paying 20% interest. I'd much rather be paying 6% interest across the board on the full $200,000 amount. I think most of us would. So you will see this example in a couple of their videos. It's in my opinion, it just doesn't hold water, quite honestly. Okay. So back over here to the credit card, $13,000. We're going to make a $2,000 payment. We have $217 interest. We're paying off a principal of $1,783, and that leaves us with an ending balance of $11,217. You'll notice this is very similar to the amortization schedule over here. They really kind of work the same way, which means at the beginning of month number 2, you now owe $11,217, and you continue to pay this down. Now, in the example in the video below, they come into month number 7, and they chunk in, I think it was on month number 7, they chunk in another $13,000. And again, your interest drops. You're down to $138,000 over here. It's a difference of $92,000 in savings. And again, you can kind of see that, right? If you look at your interest column here, you can kind of see that you were paying $1,000 in interest. The minute you dropped in that $13,000, which goes towards your extra payment, so not only are you paying that $199 we talked about before, but now you're paying another $13,000 on top of it for a total payment towards your principal of $14,199. So your interest goes from being $1,000 in month 1 to $934 in month 2. So roughly a $65 savings. And that's going to continue throughout the life of the loan. That's why whenever you get that savings and interest, that you see your interest up here continues to drop. Same thing down here. Once you drop in that $13,000 at $927 interest, it's going to drop down to $860. So again, you're saving another chunk of interest, and you'll save that interest for the remainder of the loan. You'll also notice that your payments are actually going down. So we were at $360 before. You are down to 261 payments. So you've cut off about 100 payments here by chunking the $13,000 and then chunking the next $13,000. The problem is, again, you're simply moving that $13,000 over to a higher interest rate credit card. And under the example he gave before, you were chunking at month number 7, which means you never really paid off your first your first $13,000 balance on your credit card, because you're paying $2,000 a month. You never pay that off. If you look, we still had a balance of about $1,844, and then we chunked in another $13,000, which means my balance goes up. So this will go on and on and on, by the way. So the example is a little bit off. You could argue and say, well, we won't chunk it over here in month 7. We'll move it down to month 8. That's fine. Regardless of how you do it, if you look at your payments here, you look at your total interest payments, right here, total interest I'm paying on this $13,000 at 20%. If I pay it off, and oh, by the way, I still have to continue it down over here. So I got to pay off, let's say this is going to be 844, and I'm going to pay 1844. We'll drop this for right now just so it doesn't convolute things. And that's going to leave us with a $31 interest payment. So let's move that up to $1,875. No, wait. Okay. So basically I have to pay about $875 in interest on this $13,000 that I borrowed over here. This is $875 in interest. Simple amortization schedule for your credit card, paying 20% interest. Now the question becomes is, how much am I saving over here in that interest? Real simple. If you went from $1,000 down to $934, and let's say we were going to save that for the next, let's say next 7 payments, or I should say 6 payments, because we're going to chunk again on month 8, and that's how long it's going to take us to pay this off. My average here is 930. So you can see right down here, average is 930. So the difference between 1,000 and 930 is $70. So over the next 6 months, I'm going to save $70. So that works out to be $420 that I'm saving in interest over here. However, I'm paying $875 in interest over here. So again, simple math here, you're paying 20% interest over here. You're only paying 6% interest over on your mortgage. You're going to pay more. Now, does the example look nice on paper? It definitely does. As a matter of fact, if you look at the full what I call velocity banking model, and basically what this is this is 13,000, 13,000, 13,000, all the way down throughout the life of the loan. You will pay off the loan in 78 months. I believe that's about 6.4 years. So you will definitely pay off the loan quickly, right? The problem is you continue to borrow this $13,000 over here. So if you look at your credit card over here, where you're taking $13,000, you're taking $13,000, and by the way, you can't do it at month 7. You have to do it month 8 because it's going to take you that long to pay this off. You are going to end up paying let's call it $9,500 in interest on your credit card. Okay. Now your total interest on your loan over here is $40,000. So $40,000 and some change, right? So you could say that your total interest for the entire thing is going to be, let's just ballpark it and say it's going to be $50,000 interest. It's a big savings in interest from the $231,000. It definitely is. There's no doubt about that. However, if you were to come back to your original amortization schedule and simply take that $2,000 payment that you're putting in over here, we saw the $2,000 payment before, as a matter of fact. Let me type that back in just so you see it. Remember the $2,000 payment we were paying right here. If you were to simply take that $2,000 as opposed to putting it into a credit card or borrowing against a credit card and paying that credit card down and put it into what they call extra payments. Actually, let me do this. Fix that cell. Here's my $2,000 extra payment. I'm not paying it into a higher interest rate credit card. I'm simply paying it to the principal of the mortgage every single month, $2,000 every single month. Now my total interest becomes $40,414, which is about a $9,000 difference. Look, $9,000 and some change difference between going through the velocity banking method by just simply paying it into your existing mortgage. And you'll see that I believe it's at 76 months. You're at 76 months here. So roughly right around the same time, 6.4, 6.3 years. Now, the argument that the Velocity guys will give you is that when you pay this extra payment here of $2,000, it's gone. The lender has it. You cannot pull that back out. You don't have a line of credit that you can leverage in case of emergencies. That money is gone. And they are right. It is gone. Don't get me wrong. The problem with their model, and let's go back to it again. Let's put that $13,000 over here. The problem with their model is that all of your disposable income is going into these payments over here. And you have an open credit card. So emergencies are going to happen, right? Life changes. You're going to get to a point in the next 5 to 7 years where your house is going to need a new air conditioner, where you're going to have some unexpected medical bills, where you're going to have to buy a new car and put a down payment. Let's say you can't make one of these payments. You can't make a $2,000 payment in month number 3 because you're going to buy a new car, or your home air conditioner goes out. Home air conditioner is going to run anywhere from $5,000 to $7,000. If home air conditioner goes out, you have to put the money towards it somewhere, right? Or get it from somewhere, right? All of your disposable income is actually going over here to this credit card now. The $2,000 that we saw before, and again, going back to the example, the $2,000 is coming from your savings of $1,400 and your credit card you've already paid off. You have no other disposable income at this point in time. So looking at this, if you can't make this payment, I want you to watch what happens to this $875. Let's say that's at 0. I can't make that payment. It now jumps up to $977. It jumped up over by $100. Why? Because I'm continuing to be charged interest. And I went from 9404. I didn't make my payment. And even if I make the minimum payment, it doesn't really matter. I'm still kind of right there at that $9,400 to $9,500. And this throws your whole cycle off, right? Things are going to happen. Again, it may not be back to back. You may, again, if you had an air conditioner go out, you might not be able to make the payment for 3 months because it's going to cost you about $6,000 to get a new air conditioner coming in. And where are you going to get that from? You are already leveraged on this credit card here. Now you're up over $1,000 by missing those 3 payments, $875 to basically about $200 more. That's risk. That's a risk you're going to have to face, right? That's risk number 1, is that things happen. Now, underneath the model over here, if you just simply apply it to your principal, and let's just say it's $2,000 again, great, we're at $40,414 in interest. Let's say in month number 3, for some reason I have something unexpected come up. I cannot apply my $2,000. I cannot apply my $2,000. I cannot apply my $2,000. Does my interest go up? It definitely does. Okay, went up by about $2,000 and some change. Am I in the hole for anything? No. I have that $2,000 that I had in savings, at $2,000 that for my credit card that I paid off, and I can apply that to my new air conditioner. So much safer under this model. So that's risk number 1 you're going to face. Risk number 2 is managing this, right? There's a thing in investments that's called simplicity, right? The best investments are the most simplistic investments. You put your money somewhere, you let the investments ride, if you will. You don't try to manage it too much. You don't try to go all over the place. When you think about in today's world, you have your bank account, and all of a sudden you have your car payments. You automate a lot of that stuff, insurance and stuff like that. But when you think about this, you're going to have to manage this. You're going to have to make your minimum payments over here. And again, let's just drop this $13,000 in up here. You're going to have to manage 2 things. You have to manage your mortgage over on the left, and then you're going to have to manage this credit card. And if you get in trouble over here, you can get derailed really, really quick. And now all of a sudden you have a credit card payment that you're starting to get behind on. So some of the risks you kind of have to worry about. And again, I guess I just don't see it. I don't understand why you just wouldn't take that $2,000, drop it straight into the principal. You actually pay it off just as fast. You pay it off with less interest, almost $10,000 in less interest. You have the flexibility of not being locked into a higher interest rate credit card. So you don't have all the risk associated to it. You don't have to manage multiple accounts. You simply manage one account, and that's your mortgage. And again, I got to go back to their example. I'm not so sure a lot of people are actually bankrolling $1,400 a year on an $75,000 to $85,000 salary with everything, that all your additional cost over here. And again, $450 for meals is very conservative. If you wanted to throw in a coffee every single day, Let's say for 30 days you did one coffee, and that coffee was $5 for a coffee, which is not uncommon. That adds another $150 just to your food budget alone. So now you're at what, $455, $600 just in food alone. So some things to think about if you're trying to go down the velocity banking route to pay off your mortgage early. My personal opinion, it's better just to drop the additional payments straight into your mortgage. You'll pay it off in that 6.5 years. You'll save about $10,000 of having to move money back and forth, and it's just much more simplistic, and you don't have the high risk that I see with this. So again, if you're a velocity guy or girl, feel free to chime in below. Let me know what I'm doing wrong. Perhaps I'm doing something entirely wrong here. I'm just totally missing the point here, but I'm looking at the numbers. I just don't see how it's going to be any safer, less risky to do a velocity banking and a higher interest rate credit card, moving the money around. But again, maybe I'm missing the point, so feel free to chime in. Let me know what I'm missing. Thanks for watching. Sorry it's such a long video, but thanks for watching.